Hey guys, lightly trading from home today, back from the home office. I just wanted to put this video out there because I believe it was Ike in the Discord mentioned that I could probably do a better job putting bullet points up. So I just wanted to discuss hedging briefly. For all of you that were terrified this morning, like myself, and saw their portfolios down a tremendous amount, and then the market recovered, and you got a chance to breathe and reset yourself and form a trade plan, decide which stocks you want to exit from, which ones you want to stay in, and perhaps selling covered calls against some positions if you're going to stay in them to generate some cash, setting stop losses if you want to stay in them, but if it goes below a certain number, you'll get out. But what is a hedge? So a hedge is when you're taking insurance policy out on your stock. What are you doing? You're going the opposite direction. Well, you want your stocks to go up, right? But you're saying, you know what? I'm going to take a short position, or I'm going to take puts, which is basically betting on the downside. I'm going to buy puts on, let's say, the SPY. So if you were buying puts, let's say on the SPY, and you're in them at the money puts at the 660 level, and on Monday it opened up at 650, you would make $10 per share. So every contract is 100 shares. So you make $1,000 for every one of those contracts at that level. So if you had 10 of those contracts and it cost you $5,000, you would make $10,000 if it dropped that far. On the opposite side of the spectrum, you would lose the entire $1,000 if it expired out of the money, like it went up to 665 and there was no stop loss in. You would lose all that money. But what is it? It's insurance. You have insurance on your house, you have insurance on your car. People take insurance on all sorts of things. Imagine you said to yourself, you know what, this month I'm just not going to have car insurance. Then you crash that month. You'd be devastated because you'd have to pay all cash for your car. So the same thing with the market. When markets are volatile, you can hedge in different ways. You can take puts on the QQQ, as Ike mentioned. I like to do the 3x leveraged SQQQ calls because they also pay a dividend. And if it expires in the money, I take them deep in the money. Then I'll just own SQQQ for the following weeks to come. And if it rallies, if I miss the short, I'll get it at a future week. I like to take puts on the SPY. I made a big mistake yesterday that turned out in my favor. I had a stop loss on my puts, and they stopped out, and I lost like $1,000 or $1,500, $2,000. I don't remember exactly how much it was, but when I saw the market down this morning, I'm like, oh, I would have been up 30 grand. So you can't have these emotional swings. It's very important to take insurance. Another thing you can do is buy the VIX. Not right now, not when the VIX is at 25, 26, 27. What the VIX does, it measures the volatility and the price swings. So a low VIX means the market might only move 1%, a month, a day, whatever it is. And a high VIX might be 2 or 3 or 4%. As you see, the VIX was at 25, 27, and the SPY dropped down a massive percentage. So the higher the VIX, the bigger the price swing. Sometimes they say when the VIX is high, it's time to buy. But there's a specific target of VIX being high, and you always have to watch the news. Please stay safe, everybody. If you have any questions, text me in the Discord. I love you. Peace out. Happy and safe trading.